All right. So I'm going to go through monthly market call for the GTA for the month of May. Couple of things we're going to cover today. Going to go through interest rates, job growth and unemployment, are a big one. Macro, just a little bit, but not a ton. I'll talk about financial sector. The Bank of Canada put out their annual financial sector review. And there's a couple of notable charts there. Talk a little bit about the condo market, GTA market, and potential for recovery scenario. Because I think that the goalposts kind of continue moving on that, what that recovery scenario looks like. Um, as always, like to start with a little bit of a call to action. If you like what you see here, and you want to get started learning more about how I do this analysis, or kind of just how to get to the next level as a real estate professional, you can join our agent academy. It's just school.com/agent, AIGENT. That's our play on the word because we pronounce it agent because the word is kind of just permanently changed. It's a pretty cool and active school group. There's a ton of content from myself and Dave Hutch, as well as other agents at our brokerage on how we're using technology to be more efficient in our businesses and just level up as real estate professionals. Let's get into it. So start off with interest rates. The big theme here obviously is that the Bank of Canada is still fighting somewhat persistent inflation, and inflation's kind of confusing because you've got these two metrics that they use. So this is from Statistics Canada's website. So you've got CPI, which is the light blue line, or sorry, the dark blue line. So that's your consumer price index, and you can see it's fallen in the last 2 months. So it feels like, oh wow, we might be winning the battle against inflation. But if you go to core or CPI excluding energy, inflation's actually rising. So the improvements that we saw in inflation came from um, the carbon tax being removed from fuel prices, which, it's funny. It's kind of ironic. I like to laugh about it in hindsight because we were told by the government that the carbon tax wasn't inflationary, but now all of a sudden, now that it's being removed, it's disinflationary. So I guess they were wrong, but um, the carbon tax being stripped out, it reduced, I think it had like a 0.5% impact on inflation. So inflation came down, but if you take that impact out, inflation is actually rising. And the Bank of Canada is going to be paying a lot more attention to core inflation than CPI. And so they might not be as eager to cut rates as you might think when you're just looking at the CPI. Next here we have the bond yields and what bond yields are a good reflection of what the market thinks is going to happen with interest rates moving forward. Government of Canada 5-year bond yields are up on the 3-month outlook. So this is a 3-month outlook here. You can see they're pretty high. They've come down a little bit, but they jumped up actually on that CPI reading in Canada with core inflation being high, even though CPI was low. And so you'll probably see some upward pressure on fixed rates over the next couple of weeks. And this is basically the market communicating to the Bank of Canada that um, they don't expect the central bank to cut rates at least at the next meeting, if bonds are in a rising rate environment. All that being said, the bond market has a pretty bad track record of being able to predict the market. So if you look at the light blue lines here, that's the bond market's expectation for what was going to happen with rates, and black is your actual effective rate. And this is in the U.S., but similar thing in Canada. I mean, the bond market is generally not super good at actually predicting what happens with rates. Um, the other thing is what consumers actually expect is going to happen. And if you look forward at 2-year consumer inflation expectations, you can see that consumers actually expect inflation to continue rising. And so this is another thing the Bank of Canada is going to be aware of and trying to control for, because you don't really want a economy where people are expecting things like Canadians have this pretty strong inflation psychology. So what that means is basically if they think the price of things are going to increase, then they go out and spend a bunch of money to to um, not or to kind of like front run those price increases, and that means that like you'll get a big rush of demand, and actually cause more inflation. So inflation begets inflation. This is like there's this thing called the pivot paradox, where like if consumers think the government's going to pivot, like switch to cutting rates, they'll again try and front run that to get into assets before that. Same thing happens for deflation, right? Deflation begets deflation. This is what we're seeing in the housing market right now. So prices are deflating in the housing market, and so consumers aren't really in a hurry, right? So if you go to Walmart and you see everything's on sale, and you're in the market for a TV, and you think, oh well, TVs were $200 last month and now they're 150, and my logic would tell me that they're going to keep falling. You're not in a hurry to buy a TV, right? Same thing's happening with housing right now. People aren't in a hurry to buy housing because they aren't convinced that house prices are going to start rising anytime soon. So there's really no reason to be urgent. Just a quick thing here. A lot of these charts, the ones like you'll see this formatting. Anybody who knows Ben Rabideau, these charts are his. I get these from Edge Analytics, and Ben was kind enough to offer us 20% off for anybody who's on this call. So just as a thank you for this call, if you go to edgeanalytics.ca, type in or use Realist20 on checkout, you'll get 20% off. I get like a lot of my info from this, so I just figured I would try and get that for everybody who was on the call in case you want to do the same thing to advise your clients or investment decisions. Interestingly, in regards to kind of that inflationary psychology rebound, consumer confidence has also rebounded since the election, a big jump up. I think a lot of this is, and I think this would have happened regardless of who won the election. I think Canadians really just wanted the election to be behind us, and so basically now that we actually have a result, we know who's going to be steering us forward, and we can be a little bit more confident that we have a direction. Regardless of what that direction is, we have a direction. As mentioned, I pulled a couple of charts from the Bank of Canada's financial system review. Financial stress is increasing. It's a lot worse for renters, so not non-homeowners, than homeowners, mortgage holders. So basically, you can see people that have a mortgage are down here. So your auto loans for people with a mortgage really low. Credit cards for people with a mortgage really low, but climbing, right? But it did fall off quite a bit during COVID. And then you look at your red line here. This is credit cards for people without a mortgage, so your tenant class, and then your auto loans for people without a mortgage. The key thing to note here is that all of these are climbing, and they're climbing pretty significantly since last year's report, except for auto loans for mortgage holders. But I would say most of these like credit products are climbing in delinquency rates. Another thing from the financial system review, the Bank of Canada did pretty solid work on actually softening the blow of this renewal wall that we were hearing about. They've gotten rates down pretty substantially. So from the 2024 report, we had expected the percentage of people, or sorry, the amount of increase that people were going to see in their mortgage on renewal was like 14 to 16%. Their monthly mortgage payment would increase on average. And now that's down to about just over 8% and probably into the 5% range in 2026. So, very nominal increase in people's mortgage payments. If you consider like that's in many cases a 3 or 5 year credit product. So that's less than the rate of inflation that your payment would be increasing, right? If your payment increased by 5% or even 8%, but you signed that mortgage 5 years ago, that's less than 1% increase per year by the time you go to renew your mortgage. So the renewal wall still exists, but it's probably a wall that we're capable of actually driving the car through at this point. It's not something that we really need to be concerned about or as concerned about. So the Bank of Canada has done a lot of work with rates to soften the blow of that renewal wall, which I thought, I was of the opinion that this was actually going to be a pretty substantial threat to the housing market. I think that I don't think it's a threat any longer. I think that the bigger threat is probably what's happening with rents, house prices, and demand, which I'll get to later. Impaired loans in Canada are rising of all types. So residential mortgages, again, really low amount. I do think that this number is substantially understated for residential mortgages. I think, if you look at power of sale data, power of sale is about 1% of total supply in the market. So you would assume if 1% of your people selling properties are delinquent, you could probably track that. And that's what's actually showing up as power of sale, which is a loan that's like 90 plus days delinquent. A lot of magic happens. So like when you look at impaired loans for residential mortgages, the Canadian Bankers Association only requires that you report these if they're 90 days delinquent. The interesting part about this is like, I've never been 90 days delinquent, but I know people who have, and I've lent to people who have been 90 days delinquent. Typically in in the first 15 days, it's like, what's the way out, right? Are you going to take on more debt to try and make this thing whole? Are you going to sell the property, et cetera? And so that's where you get what's kind of called like a soft power of sale, right? Where we'll tell the person to list the property on their own. It saves them the embarrassment of having a power of sale listing, and they'll go put the property up on their own. They'll likely stay delinquent on the mortgage, but they have 90 days to sell that house before it becomes a data point on the CBA, Canadian Bankers Association, delinquent residential mortgages. So all that to say, I think that there's probably a lot more mortgage delinquency than people are saying. I'm not saying that to imply that the sky is falling, but if you're a real estate professional, this might actually be a good opportunity for you to get business. I do a lot of lender dispositions, and they're very hot right now, and you're pretty much guaranteed a sale because people who are behind on a lender dispo, unless like the second is going to buy out the deal or something like that. Typically, if somebody's behind on their mortgage, that sale has to happen. So if you're a real estate professional or an investor trying to find deals, I'd be calling lawyers, mortgage brokers, et cetera. A lot of good listing opportunities from that. Consumer credit and business loans rising at a faster clip than residential mortgages. The business loans piece rising especially quickly, although bankruptcies are actually down, which I think I put that chart in here. I'm not sure, but bankruptcies are actually down from the big spike. I think that there was a big bankruptcy spike from people when the CEBA loan thing came up. I think a lot of people just declared bankruptcy so they could get out of that CEBA loan issue that happened from COVID, which was the Canadian Emergency Business. I don't know what the A was, but loan. This is the one scary chart from the Bank of Canada's Financial System Review, which basically they modeled out that a severe and long-lasting global trade war would push the rate of mortgage arrears beyond the levels reached in 08-09 global financial crisis, but not as bad as the 1990s. The 08-09 doesn't really actually scare me that much for Canada. I think we fared like relatively well. I think our policymakers don't have as much of a toolkit to fix the problem as they did in 08. Like in 08, Canada was very low leverage compared to the US and a lot of other countries. And so we actually just started our credit addiction during 08, and we were able to keep our rates low for a much longer period of time than like the US, the UK, et cetera. And our prices didn't get as impacted as much. Our unemployment didn't go as crazy. There was a handful of things that made it a lot easier for us. The 90s is like you're kind of getting to the 90s level at the top end of their forecast here on the right-hand side of the chart. The 90s was a lot worse for us, right? Like 90s was like a really, really bad time. And you can see there was two waves, right? So you saw that first wave, which this would be your kind of, I do think that the setup is very similar to the 90s. I think the one thing that'll keep this number low is the fact that like we don't have a huge accountability environment. You have this like Canadian mortgage charter. Lenders have to be nice to you if you can't pay your mortgage, et cetera. But I just want you to observe kind of the pattern of what happened in delinquencies here. You saw this big spike in 91. So what happened was like 89, there was a record immigration, record house price growth. House prices went to the moon, then they blew off, dropped like 20%. And I'll get to the comparative drops in a second. And then you saw that period, and then it kind of grinded down, and the market grinded sideways for a little bit after that. And then there was like a little bit of a second down leg, which, if you're to map these over one another, we're kind of getting into that second down leg now, right? We saw the big drop in 2022. And then it's basically been sideways since then. And we're just kind of rolling over into that second down leg of house prices in Canada right now. That could lead us to that second spike in mortgage delinquencies. Like we have seen a relative increase. Again, it could come down or kind of flatline, and then it could increase again. So that's really what you want to be watching for right now. But also, like, if we're just thinking purely transaction, these are opportunities for us as real estate professionals to get deals, right? So, people who can't pay their mortgage have to sell their property, and there's a lot of buyers out there looking for distressed deals. The one call to action that I run on a quarterly basis is giving people access to a power of sale list. Peter, who's listening in on this call, does a really good chart on it as well. I actually just stopped doing the chart myself. I just use his, but basically just shows the number of power of sale listings on the Toronto Real Estate Board. Right now, there's like almost record supply of power of sale listings. So if you go show somebody a picture and say, hey, there's more power of sale listings, or there's like a relatively high number of power of sale listings right now, contact me for a list. It'll astound you how many people come out of the woodwork that have not responded to any of your other call to actions on social media, but now all of a sudden that you're offering a distressed deals list. I don't know, people are assholes or whatever. They're just sharks wanting to circle, see blood. I have no idea what it is, but people want distressed deals. So there's some opportunity there. Job growth is really, like, to me, probably the biggest factor in the next like couple of months in Canada. A big reason for that is first-time homebuyers are really the ones like propping up the market right now. And the bottom end of the first-time homebuyers are your people leaving university and joining the employment market. And job growth, or sorry, the unemployment rate for recent grads is, other than the COVID period, is like the worst it's ever been. And I would just kind of scratch that off. And it's not like this is some new thing. Like this, if you draw that trend line, that dotted line that I grew there, like this is a trend that's been taking place. It's been shaping up over the last several decades in Canada, where we're really not valuing the talent that we're training in Canada and trying to make them successful in the job market, because we have high demand for people to move to Canada, and they're willing to work for a lot cheaper. And the Bank of Canada actually did a pretty thorough study on that. I was going to put some charts on it in this call today, but I just didn't get around to it because the report's kind of fresh. But I posted a couple on my Twitter. But basically, like it's clear that there was that the temporary foreign worker program was really designed to kind of reduce labor costs, and this is the consequence of that, is that the people who are paying into Canada's education system, paying hundreds of thousands of dollars, in many cases going into debt, are graduating into 11% unemployment. And so if you imagine yourself when you're finishing university, maybe you're 22 to 25 years old, first thing you're gonna be thinking about, getting this sweet job that you were promised when you went to university, maybe renting a place for a couple of years, saving up some money, and buying a house. Well, now you've got basically an 11% reduction in the size of that market. So in a couple of years out, to me, this really dampens the potential for first-time homebuyers to play a meaningful role in the recovery of Canada's housing market. A lot of this comes from, again, the study permit thing, where we've been told that study permits, international student study permits, are going to be reduced, but they haven't really. International student study permits were 122,000 in 2024 and 97K, so the second highest number of international student permits. So still like 50% above the average number, or sorry, over double the average number of international students. So again, sustained downward pressure on wages, sustained upward pressure on unemployment. The youth youth employment hasn't kept up with the population growth. This comes from Indeed. Brendan Bernard, great follow on Twitter if you ever get the chance. Job postings, relatively steady. So it's not like we're actually seeing less jobs. Unemployment's really coming from labor market composition. There's more people entering the workforce. You're not, like, again, we haven't seen mass layoffs yet. We haven't seen a lot of these things, but unemployment's still just steadily trickling up because there's more people that need jobs than there are jobs. If you look at it on an annualized basis, we are lower than the last 2 years. So 2025 is lower than 24 and 23, and substantially lower. So this will have obviously an impact as well. And And on for the last 3 months, we've seen pretty weak growth in the job market. So all of that to say, like from my perspective, and I'm going to post a affordability chart in a little bit, but there's three things that can improve housing affordability. One is wages go up. Two is interest rates come down, which we've seen already. Three is house prices come down, which we've seen already. The wage growth piece, if wages aren't growing, which it doesn't, there's no scenario in which I believe that should take place. Um, you're really going to have a hard time for housing affordability to recover without prices coming down or interest rates coming down. If rates come down a little bit, maybe another 50 bips, that'll do some work. But we really could see without wage growth, we could see like house prices always return to that long-term average, and the average is really easy to understand. People will buy houses when they can afford to buy them, and right now we still haven't gotten to a point where people can afford to buy houses. At least in the GTA and Lower Mainland. In many other places in Canada, and I'll kind of get to that as well, people can afford to buy houses, and those markets are ripping. But in Ontario and BC, that's not the case, and those markets are getting smoked. The next piece, like I hear a lot of people talk about this recovery scenario in like 2027, that all the condos, pre-con pipeline is going to drop off, and there's going to be this huge gap in supply, right? I'm not necessarily convinced that that's actually going to happen. And I actually think that the market will be well supplied. I think that we are really like, again, go back to the 90s comparison. 89 to 2002 was the peak to trough, back to peak, right? So like 14-year recovery period, 13-year recovery period. I think we're gonna have a very similar setup, right? It'll take a really long time. Like it's not like 2027 is gonna happen. Nobody's building new condos because pre-con demand fell off a cliff, and all of a sudden condos are just going to jump back up to what they were before, because a lot of that supply is getting backfilled by the purpose-built rental programs that the government has right now. In the city of Toronto, a lot of this is done through this program called the ACLP, Apartment Loan Construction Program, something like that, Apartment Construction Loan Program. Because MLI Select, CMHC's other program, doesn't really work in the city of Toronto, just based on like the numbers. I won't get too into the algebra of it, but multifamily building permits nationally are very high right now. Like they haven't come down, and you would think that they would, right? Because we're hearing that but pre-con isn't the only way that we deliver housing supply. And actually, we're seeing a big shift away from, and I like this shift, by the way. Like I'm a huge fan of this shift. We're moving away from this model where a high-rise builder would pre-sell a bunch of units, and then all of those units would get absorbed by foreign investors or domestic investors or whatever, and then those people would become the landlords, and you'd have like a building with, I mean, you guys have all been in these buildings or heard of them, heard the stories, right? You have a building with 300 absentee landlords and a bunch of young people living there, and the buildings are just a mess, right? And whereas you go towards these purpose-built rental models where you have one landlord, they're professional, they manage the building cohesively. The tenants get a way better deal, right? The tenants get a way better quality of life. They're not at risk of own use eviction or rent eviction, because corporate landlords can't do that the same way that individual landlords can, or mom and pop landlords. And it stabilizes the rental market a lot, right? So to me, this shift of our high-rise, mid-rise, like any apartment supply away from condo to purpose-built rental is actually a really good thing. But it is a thing, is the more important part. And a lot of your rental supply is going to come from that. And so imagining that there's just going to be a supply gap in 27, 28 when the pre-con pipeline dries up might not be as profound of a recovery scenario as people would like to imagine. Peter posted that wicked chart in the chat, by the way, so I would encourage everybody to take a look at that. Are we at record? We're almost back at record, eh, Peter? So the piece where you actually want to think about a supply gap is in single family, right? Single family building permits, almost the exact opposite of the chart that we just looked at. This one comes from Ben Rabideau as well. Long-term downtrend, right? So we're building more apartments, and now we're building institutional apartments, right? Not condo apartments. And your single family is basically toast. Like, I mean, the lowest single family building permits we've ever seen. And our population, you have to imagine, like comparing this to the 80s, other than that big drop, which was the 80s recession, the comparing to that period of time, our population is like what 10-15% higher than back then. So relative to population, this is like a huge undersupply. So single family will probably actually have a recovery scenario based on this supply absence thesis. Multifamily probably will not. And this, again, to go back to that purpose-built rental thing, this is another chart from Ben Rabideau. We like this does not show any signs of stopping, right? I mean, maybe now because your forward-looking rents are not good. And so a lot of people who are contemplating building purpose-built rental are saying, maybe I'm not going to do that. And I'm going to go through a lot of things on rents towards the end of this presentation. But purpose-built rentals under construction, this is in your CMAs, so your major cities. We're at a record number. So there is supply. It's just not the condo supply that people were thinking. And so it won't interact with the resale market in the direct way that we were thinking before. We will interact in the resale market in such that it's going to have sustained downward pressure, or at least limiting the upward pressure on rents. So your vacancies will rise, your rents will fall. Pre-con condo buyers aren't going to be lining up to buy when rents are falling. So a lot of your condo and pre-con supply will actually end up going more towards your end user buyer. Again, I think this is a very healthy thing. We need to get to this market. If we could have done this 10 years ago, we wouldn't be dealing with this mess. So I think this is probably a really, really positive outcome for Canada's economy, but this limits the recovery scenario that a lot of people imagine. The other way to think about supply is just relative, right? So Ontario is actually okay, right? I know a lot of the people on this call are from the GTA. So in Ontario, relative to our current rental stock, so take all of the rental units. Again, another chart from Ben Rabideau. Honestly, guys, absolute beauty. So subscribe to his Edge thing just to support him. He's a great guy and he deserves it. But so you take all of the rental units under construction, all of the rental units that exist in BC. Let's say there's 100,000 units. I don't know the exact number, but under construction right now, you would have 15,000, right? So 15% of all of the rental stock that exists in BC is under construction right now. If BC's population grows by 1%, and in, let's say, a bunch of people leave their parents' house, leave from living with their parents and move into the rental market, and that gives the rental market another, 3% demand increase. You have a 10% increase in supply above demand. There's no way that this doesn't translate to an instant increase in vacancy. And you can see this coast to coast. And I'll give you a really good example of this in Calgary. So in Calgary, this comes from CMHC's fall 2024 rental market report. So in Calgary, 2023, vacancy was like 2%. And everybody was like piling into the Calgary market to build rental, right? All these pre-baked CMHC deals, pre-con investors in Toronto were loving them, gobbling them up. They're doing the same thing in Edmonton right now, and the setup's the exact same, and the chart's going to look the exact same as this. Sorry, guys, hate to say it, but so you underwrote your deal at 2023 vacancy rates 2%. Takes 1 year to build. You close your project 2024 vacancy rates 7.1%. Why? Because everybody else had the same idea, and the market got flooded with supply. And so a lot of these loans got right-sized because people were closing in a 7% vacancy environment and they were underwriting in a 2% vacancy environment. Go back to this chart here and imagine how this would look in Atlantic Canada, where 12% of their rental supply is under construction right now. In Alberta, where over 8%. Ontario actually looks pretty good comparatively in that regard, right? The rest of the country could see an oversupply. Like, I honestly actually think that in the short term, we're at pretty severe risk of oversupply in the Canadian market. And I think you're going to see this materialize in big drops in rents and big increases in vacancy. The other piece of supply that is worth thinking about is active listings, right? So this is GTA. Active listings right now, among the highest that they've ever been, right? You've got, I think, 2 years where we've had higher, and April's not done yet. And May's not done yet. So well, I guess I'm only have April data here, but you're looking at a lot of resale supply. Resale supply is a little bit different because it's not brand new. So if somebody's selling a resale house, they're losing their unit as well. So they're all their demand. So they net out, right? So if I sell you my house, I have to go buy another house or I have to go consume another unit. And so it's not as impactful, but the resale market is putting a ton more supply in here. So I actually think like the economy solved this housing supply crisis that we've been hearing about very efficiently because policymakers didn't for the past 5 years, and this is where we saw this very violent recoil in the supply and demand metrics across Canada. Okay, I'm going to jump to the mortgage market. Any questions? Just while I'm segueing here? No. Okay. Um, Okay, so CMHC put out this other their mortgage consumer survey. Some really interesting data points in here. A lot of these are just good uh, for you as real estate professionals or investors on the call on where you can think about your kind of next sources for deals. So, the first one, interesting. Buyers are increasingly paying the maximum price they can afford. So more people paying the maximum price they can afford this year than last year. 58% in 2025, less than 50% in the last 2 years, but still less in 2025. So less this year than at the peak 2022, where almost 70% of people were paying the maximum price they could afford. If you look at this in BC, it's 66%, in Ontario, it's 64%. And if you look across Canada for first time home buyers, it's 65%. I did a YouTube video on this. If you want to go watch it, I went through their mortgage consumer survey. Just go to my YouTube channel. Just search Daniel Foch on YouTube. I just did a full page turn on it. It's about 10 minutes long. I'm going to go through a couple of the key things here as well. But first time home buyers are the ones that I've really been paying a lot of attention to because they're the biggest source of demand in Canada. I've put this chart in many of my decks, and I like a lot of people like to demonize investors and say, oh, investors are blowing up the housing market and blah, blah, blah. Um, and I just disagree. I frankly disagree. I can't see how the smallest buyer in the market and probably the most rational because they buy based on quantitative metrics, not qualitative metrics. So they're not really quantitatively incentivized to overpay. Whereas first-time home buyers could be like, oh, yeah, I'll pay 50 grand extra for this house because I just love it. I can see myself living here for the next 10 years and raising my kids and whatever. An investor's not going to say that, right? Whereas other 80% of buyers, repeat and first-time buyers are. They're the less rational consumer, they're the more qualitative consumer, but they're also they're the biggest amount. And so what first-time home buyers are doing really matters to me. CMHC came up with this profile. First-time home buyers are 12% of all mortgage consumers right now. The most mortgage consumers, by the way, is renewers, which I'm going to get to. This is a survey from CMHC, so take it with a grain of salt, okay? But a couple things stood out to me here. The majority of first-time homebuyers think that consider their house to be an investment, and they think that real estate's a good investment. The majority of first-time homebuyers think that their house is going to go up in value within the next 12 months. Okay, this is from the CMHC report. 17% of first-time homebuyers report missing a mortgage payment. 60% of them have had difficulties maintaining debt payments, and 26% of them would use one credit facility to pay off another. Repeat buyers, only 5% of mortgage consumers. The reason repeat buyers are a smaller number of the market, by the way, don't overcomplicate this. It's because they already own a house, so they don't need to buy a house, right? And that's why first-time home buyers dominate the market. Repeat buyers, far fewer missed a mortgage payment because they have equity padding. Far fewer use one credit facility to pay off another. The majority of them are taking fixed rates, and the three main reasons that they chose to buy in the last 18 months is a change in living situation or marital status. So this is a big piece of your buyer, right? You get your buying and selling pool. You get two ends, upsizers, downsizers, whatever, change in living situation, almost 50% of them. This is what keeps the market moving when people are dissuaded by the economy. Your first-time home buyers and your investors are entering or exiting the market. Like first-time home buyers are entering, so there's a timing element. Repeat buyers, there's less of a timing element because they're trading in the same market. So they're buying and selling. If they say, oh, if prices are way up, well, the house that I'm selling is up too, and so the house that I'm buying, and so it kind of nets out. Same thing if prices are way down. The house that I'm selling is down, and the house that I'm buying is down, so it nets out. Renewers, 65% of the mortgages in 2024. Yeah, 2024. 12% of renewers report missing a mortgage payment. This is crazy, crazy data points. Okay. 20% use one credit facility to pay for another. Wait till I get to refinancers. Almost 50% of people report having difficulties maintaining debt payments in Canada. Okay. These are people who are renewing your mortgages. And 64% of them have already been impacted by the rise in mortgage payments. 14% will soon be impacted. Once you get to 100% of people who have been impacted by the rate increases, you're in a new market. You're past the credit cycle, right? Like, you're not done the credit cycle until everybody has absorbed is in the same market. There are still people out there right now who are paying mortgages on 1.6% interest rates, right? And so until that washes through the economy, the credit cycle isn't finished, and we don't know all of the consequences of these changes. These are your refinancers. 20% of refinancers report missing a mortgage payment. 30%, almost 30% of them used one credit facility to pay for another credit facility. So this is like your refinancers. A lot of them are doing it because, I mean, why would you refi in a current market? Because rates are up, right? So a lot of them are doing it to solve debt with more debt. These are all, from my perspective, these are qualitative data points. So again, take them with a grain of salt, but really concerning stuff for Canada's housing market. An interesting thing that came from the CMHC report is the use of secondary suites. 28% of mortgage consumers already had a secondary suite in their house. I had no idea that there was this many. That's actually pretty extraordinary. I guess all the people who don't have secondary suites are the people with paid off houses. And 1 in 10 people were planning on adding one. So if you're, again, an investor or a real estate professional, this is a really important thing to become an area to become an expert in. Actually, I'll soft pitch. I didn't put a deck in here, but I'm literally doing a multiplex webinar tomorrow. If you just search Google multiplex webinar, it's on the Eventbrite for the Canadian Real Estate Investor podcast. But it's with Jaden from River Developments in Toronto. They're a big 4+1 developer. Anyway, the biggest reason why people are considering putting in secondary suites: cover mortgage payments and expenses. Crazy stuff. 75% of people are planning to renovate in the next 5 years. So again, that could probably dampen your potential for people who are selling and upsizing if they're considering renovating their house. Because the primary reason is they want to customize their home to meet their needs and preferences, rather than trying to make it worth more, which is the second most valuable. And those people might actually be, doing it maybe more for sale. Most people are going to be funding these renovations from savings, not from, second most would be from HELOC. And there's a substantial increase in the amount of people who will be doing it from HELOC, from 36% last year to 46% this year. So more people are planning to fund the renovations from debt. Okay, let's get to house prices. Housing affordability, I mentioned before, it's rolled over in every market now. Calgary finally rolled over from prices coming down. I've referenced this a couple of times, but I like to bring it up on like maybe a quarterly basis. But you go back to every major housing cycle in Canada, and you can see this like double peak of housing affordability. Sometimes it's pronounced like the 90s here. Sometimes it's not, like the 80s here. But what you see thereafter is this gray bar, where the shaded gray behind is a recession. And we have a pretty clear double peak here. Peak number one is we get to a point where house prices are out of control, and the central bank says we got to crank rates up here. And so they crank rates up, and house prices drop substantially. That's where you see the first drop. And then you kind of stabilize. And because people are buying at higher rates and prices haven't continued going down, you see this big increase. That second increase comes from people buying with more expensive debt. And then once you get to the second peak, the Bank of Canada's work has been done, and they've crushed the housing market. Not that that's their only mandate. And then you get to the cutting portion of the cycle. Bank of Canada starts cutting rates, and that's where you see the second decrease in or improvement in housing affordability. And so we're on that right now. There's no really knowing how much farther they're going to cut, how much farther that improvement will happen. Sometimes you do see house prices continue to fall during that cutting cycle. Actually, most times, but just not as severely as that kind of blow off top that you saw in like Q2 2022 when they first fired the warning shot on the hiking cycle. House prices are basically flat. If you look at them against the S&P, they're clearly underperforming. And from a drop perspective, off peak, this is another chart from Ben Rabideau. We're actually looking at the largest cumulative national house price decline from peak. So this is the worst housing market correction that we've seen in Canada. A lot of people are afraid to say this. And I think that to me, this is like a motivating thing for people who are either buyers or like if you're an investor, because or if you're a real estate professional where buyers are really trying to figure it out. As like it's so funny, right? Because you go back to 2021 and prices are ripping up and people are piling into the market. But as prices go up, there's more risk below you and less upside above you, right? The upside's getting realized and the risk is getting created. And then as prices come down, nobody's lining up to buy houses, yet it is safer. Like every day that house prices trend down, there's less risk below you, right? There's less room for prices to fall, and there's more upside above you. There's more room for prices to rise. And so to me, this is actually probably the most important chart in Canadian real estate right now, which is we are, and I'm not calling the bottom by any means, but I think trying to time the bottom is a fool's errand anyways. My prediction on what I felt the bottom would be has been the same for a long time since we kind of saw that roll over in 2022. I think it'll probably happen in 2026. I think it'll be a long, flat bottom. Probably the entire year of 2026 will be the bottom of the Canadian housing market, and it'll just be flat. How much more downside risk do we have from here? Who knows? Maybe 5-10%. Depends on how much these guys keep shooting back and forth on the trade war. Could be more than that, really. But I think that's maybe coming to an end. Anyway, all of this to say, the further that prices get down, the less risk there is. The further that they rise, the more risk there is. Relative to income, house prices, not, or sorry, this is in the higher tiers, incomes are actually outpacing the income needed to require a house. It's the lower in this. Again, this is kind of your first time home buyers. Your lower income households that are having a hard time, and those are the people we need to kind of like create that the lower end of the demand curve to keep the market sustainable. So if the market's not favorable for first time buyers, this is why policymakers are so obsessed with trying to make things easier for first time buyers. They're the ones that are going to prop up the market again. And policymakers know and agree with me, I think, that they're kind of like the dumb money in the market, right? They're inexperienced, like by nature. They've never bought a house before. They've never been through a market cycle before. They're young, right? They're probably working with a real estate professional who has no clue what they're doing because it's like their friend who's like 25 and has done 2 deals in their life. And so their irrational consumption patterns actually support the market, whether you like it or not. Because like I don't think this is a good thing, but the reality is the market has really been propped up on their backs over the last couple of years. Even COVID, the big COVID run up was a lot of it was them, right? And all of those people are underwater now because if you're buying with a 5% or 10% down mortgage, if you buy a 5% down, you're negative equity the day that you take possession of that house, right? 5% down payment. You paid your land transfer tax, you paid your lawyer, you have a 4% CMHC mortgage premium baked into your house. And if the house went down 10%, you're like 15-20% underwater. So those people are stuck in their houses as well. They're safe supply for the Bank of Canada. Active listings in the GTA, the highest they've ever been. Sorry, this is condo active listings. I apologize. But sorry, condo market active listings, the highest they've ever been. I think that this number is going to continue climbing. We've got like 40,000 closings this year. The one thing I've found fascinating on the price side is that, prices have been relatively sideways, but like list prices haven't, like sellers are really not giving much. What you often saw, like when we were in that kind of like bidding war environment, was like list price really didn't ever move. It just kind of stayed the same, and the buyers would be the ones setting the price higher and higher and higher. We're kind of in the same market, but it's the buyer setting the price lower and lower and lower. So you'll see your sale to list price ratio kind of like gradually move down, but sellers are staying the course on those like kind of 2021-ish prices. I'm not seeing that 2022 peak pricing, but A little bit on the rental market too. We kind of are getting back to the point where we're seeing that little bump in the summer, which we haven't seen in a couple of years. So rents have been trending down for a little while. This is one thing that, from my perspective, is interesting because it might. I don't think it's going to signal a positive direction for the rental market in a long time. But historically, you always saw a jump up in rents from April to May, and this is the first time we've seen it in the GTA in a long time. I think these are just slides that I forgot to remove here, but there we go. That's I think that's all I got for today. I'm happy to do any questions if you want. And yeah, any questions? Cool. I guess we're good then. I'm going to assume that I explained everything properly. Peter, thanks for sharing the chart in there. Thanks everybody for tuning in, and yeah, check out our school group if you want. We do calls like this, like kind of just like coaching mastermind calls on a weekly basis for agents who are kind of looking to level up on like market analysis,